You're listening to the Bigcast, your source for the latest in financial technology. Brought to you weekly by the Best Innovation Group, with your hosts, John Best and Glenn Servati.
Welcome to another edition of the Bigcast. My name is Glenn Servati on behalf of the Best Innovation Group, where we like to do cool things with financial technology, with credit unions, with fintechs, and John Best and I saw a bunch of both of those groups just last week when we were in Washington, D.C. for America's Credit Unions Government Affairs Conference, GAC. John and I did a pair of really good breakout and well-attended, I'd say also, breakout sessions about open banking. And then we also met with a group of CEOs and did some strategic work along those lines. Always appreciate those opportunities to interact with the industry. And always appreciate the opportunity to track down some folks that we thought had some particularly interesting perspectives. And we've got interviews with a few of those today. We've got the CEOs of two small credit unions talking about some of the things going on in their shops, and our annual catching up with the America's Credit Unions economics team, Mike Schenk and crew, with some interesting twists following their annual economic update. Something that was referred to as the Vibe-cession. We'll explain that one a little bit more in just a few minutes. You can always find out more about the Best Innovation Group by following us on our website, big-fintech.com. We've got new content here on the Bigcast. You can find all our past episodes there, as well as through your usual sources for podcasts, Apple Music, Spotify, etc. And we have new content here pretty much every Tuesday. We will also have our town hall, our pretty much bi-weekly town hall, give or take. The next one coming up on March 20th, Wednesday at 3 p.m. Eastern, noon Pacific. You can join us there for a live and lively interactive conversation, sharing best practices. Hopefully, sometimes with guests, sometimes just a roundtable, understanding what's going on in the credit union space, the primary issues, and how some of the leaders in the industry are dealing with them. It's free for everyone to attend, but you do need to register in advance. cutownhall.com is where you can go, both to check out some videos and audio of past episodes, as well as to get a registration link for the new one. So as I said, last week, Government Affairs Conference, Washington, D.C., over 6,000 in attendance from the credit union community. I believe, as I understand, that is an all-time record. I know it's definitely a record for the 10 years or so that I've been attending. It was also the first combined showing since CUNA and NAFCU brought their two organizations together at the first of this year. And frankly, was not as much focused on, the story of that combination and the go-forward mission as I would have expected, which is probably a good thing, because the story isn't about America's Credit Unions, the organization. The story is about the actual credit unions that are spread across America, and rightly, that's where the focus was. One of the messages about the mission that did come out is that advocacy is job one, which is the way it was laid out by the head Jim Nussle, the head of America's Credit Unions. And that became pretty clear while we were on the ground in D.C., the new announcement from the CFPB on credit card late fees being capped, quote unquote, I'll get back to that, at $8. That news broke, and that's the type of thing that America's Credit Unions is always looking out on our behalf for, to try to make sure that the best education and position is put forward with regard to understanding how this legislation impacts the man on the street. 6,000 in attendance, if you actually do the math, that's like 1.2 attendees per credit union that exists in the United States. That's a pretty hefty number, which surprised me in terms of the fact that it would be the largest, given that we used to have a lot more credit unions. But it does occur to me, even though there are fewer credit unions, there are a lot more CUSOs than there used to be. And that's probably where you make up the difference in those numbers. One of my favorite things this year, this is the first opportunity I've had to visit the Small Credit Union Roundtable, which takes place on Sunday, kind of before the official launch of the conference writ large. Technically, I believe the way America's Credit Union defines them, small credit unions are those with less than $100 million in assets, which is still, I believe, if I'm not mistaken, the majority of all credit unions in the country, although certainly a small share of the total assets represented. Much of the consolidation among credit unions and the decline in our total number of credit unions has come in this group. And they face very specific challenges, one of which has to do with talent. And that was the focus of this year's roundtable, really looking at ways that they can cultivate talent, attract, retain, and obviously you're talking jack of all trades with shops that are that small. A couple of people who spoke on stage that really caught my attention: Deborah Fears from Chicago Postal Employees Credit Union and James Higgins, Skyline Financial, both the CEOs of those respective organizations. I tracked them down afterwards to kind of get a little bit more perspective on what they've got going on. Let's have a listen to what Deborah and James had to say. So every year here at GAC, I always find something new that I really enjoy. This year it was the Small Credit Union Roundtable back on Sunday to kind of open the session. I've got two of the speakers from there, Deborah Fears from the Chicago Postal Employees Credit Union and James Higgins from Skyline Financial in Waterbury, Connecticut. Thanks for taking the time to talk.
Thanks for having us.
Thanks.
Now you're the vice chair of, is it the council, the roundtable?
I'm the vice chair of the Small Credit Union Committee. We report to the board of formerly CUNA and now America's Credit Unions.
Yeah. Mm-hmm. And one of the first off, say a bit about Chicago Postal.
Yeah, so Chicago Postal, we're a legacy credit union. We're celebrating 96 years of service this year. We service postal workers and their family. We're about 28 million in assets. So
still feel the membership as postal employees.
We've always been postal employees and family. We're about 28 million in assets, serving just under 5,000 members.
Wow.
Yeah, so really legacy, loyal employees, loyal members that continue to bring their sons and daughters and grandchildren.
So you're definitely seeing that legacy aspect of people bringing the family members.
Absolutely.
Now, one of the things I really wanted to talk to you about as well is you were central to putting together this blueprint for small credit union success, which is a 170-page document, I believe.
Yeah, Glenn. So it's amazing. I was so pleased. We were all so very pleased with the results of this blueprint.
Now, you put out something every year, but this is kind of a special.
Yeah, so every year we do a project. The committee works on a year-long project, just some kind of solution that would help impact credit unions around the country. And so this year we were thinking, credit unions are struggling. They're struggling, and we're so stretched for time.
Particularly small ones.
Small credit unions. Yes, absolutely. We're so stretched for time. We're stretched for resources. And while we want to be doing strategies and we want to implement different strategies, it's just difficult to figure out
Find the time.
Yeah, absolutely. So this is kind of really how this idea was born, because we know that small credit unions are awesome and they are successful. And there's small credit unions around the country who have been successful in implementing new strategies, new initiatives, being innovative. So we thought, hey, why not tell the world about these small credit unions that have done it? Absolutely. And so the end result of that was over 170 pages full of strategies and initiatives. And we have everything in there.
About 50 of them, you said?
Yeah, there's over 50 submissions. And we have everything in there, from lending and operations and talent and building branches and board training, just really anything you can think of. And it's kind of just you can lift it out the resource guide and drop it into your credit union. That's what we were hoping for.
And it's out there outside the member wall. We'll post the link to it, so if people want to take a look.
Yeah, absolutely. If they want to take a look, please go out there and take a look and provide feedback for us. It is on the cuna.org/smallcu. So you can go out there and download it. It did go live yesterday, so
great.
Yeah.
And we'll post a link to that.
Yeah, thank you, Glenn.
And James, you provided one of those strategies. Is that correct?
That is correct. Yeah. So one of the submissions we did for the blueprint was specific around training, and one of the things that Skyline has prided itself on is that the training that we provide to the staff is wholesome, and anytime there is an opportunity for training, we sign someone up, whether it's supported by our league, or it's supported by maybe a national organization, or something that we even have to pay for.
So to clarify, so when you say training, you're not talking about in-house training, you're talking about sending them out to industry events.
Yes. We've been fortunate to receive a number of scholarships that we've applied for to have those trainings completed, like in Madison, Wisconsin. There's a huge training out there for the credit union development educators, and I am a DE. I have another team member who's a DE. And as soon as those applications open for scholarships, I encourage the team. I'm like, get on there, get going,
so
make sure that you can do it.
They take the initiative. They're the ones that actually apply.
Yeah, and they're excited to do it too, because they're more than just processing the transaction. They're more than just giving the person the loan. Now they understand the why of what we're doing, and once you understand the why and buy into the why, the what just becomes natural.
And for perspective, we're talking about a credit union with, I believe it's 6 employees. Is that right?
We have 6 employees. Yep. Pre-pandemic, we actually had a height, I think, at one point of maybe 13 or 15 employees. There were 2 locations at one point. The credit union had shrunk significantly before my leadership in terms of assets, in terms of membership. There was declines everywhere. And when I first started in 2021, I recognized there's a couple of components. One, we had no technology. I'm talking a pin printer with green bar paper.
Oh, man.
Yeah, so if your mind just went back in time 35 years, that's exactly what I walked into on day one. And then with that, too, we had siloed workers. I only handle X transactions, and if you need this, you have to go to this person
with only 13
here.
people. I mean,
Right.
That's
So
mind-boggling.
it wasn't going to be conducive for a successful credit union. Within 2 years, we've done every single piece of technology that we can sign up for. That meant a new core system. That meant new training. That meant new technologies for the members, mobile banking, online banking, remote deposit capture, things that seem like we've had for 10, 15 years now, and most credit unions have. We just got that in the last 2 years. In our last round of asking the members, what do you want in 2024? They were like, we're good. We have everything. I'm like, no, but we need something. Like,
This is,
we need something else.
This is that Apple thing you don't know what to ask for until you see it.
Exactly. So, and business is what we've kind of landed on. So we started doing business loans. We do merchant services for our businesses.
Well, did you already have members who ran small businesses, or did it create a whole new member base?
We've had like the Etsy shop, the person who maybe runs something out of the trunk of their car, maybe sells like an Avon or something on the side. But now we have full-blown businesses. I'm talking about ice cream shops, bars, restaurants, and everything that you want, tattoo parlors, So like now we've become like almost a wheelhouse of information. When a member says, I need to get my roof done. Oh, okay, call XYZ Roofing Company. They're also a member, and they love that because
community
now
hub.
It's community hub. So in turn, we then turned to the business members and said, what do you want? And they're like, well, we need integration with QuickBooks. Okay, we called the core company. What's it take? And they're like, it's like $3,000. And we're like, worth it, do it. And we signed up and subscribed. So that's what we did.
Now, for perspective, Waterbury, Connecticut, kind of a standalone, self-contained community? Is it a bedroom community to another area? Where
sure.
you at?
So Connecticut is a smaller state.
Yeah.
The city that we're in has about 130,000 in population. It's considered a city for the state.
It is it is kind of the metro area.
Yeah, if you will. By no means in New York or Chicago. Like I think the population of New York is the population of Connecticut, which is fine too. But all in all, though, we actually started as a telephone employees credit union in 1935.
Okay.
And what we did was we converted to a community charter in 2022. So
Since you've been there?
Since I've been there.
Okay.
Yep. So last year we had a 6% membership growth. Our loan to shares went from 41 to 60%. And we had an overall loan growth in 2022, 30%, and in 2023, about 19%.
And I remember you mentioned that you just turned your first profit since 2008, right?
Yes. So we've had our first successful year of profitability-wise since, I think it was 2008, maybe 2009. I have to go back in the call reports. And that is huge. And we were talking significant losses year over year. To now just to be able to finally feel relief. And the membership they see it. They walk in, they experience it, they know that they're in good hands, and they have a whole lot of confidence in our credit union as banks continue to leave our area.
Yeah, and that's another key point there too.
Right.
And your asset size at this point is
38 or 39 million,
so
depending on the day.
Very similar. Your two are right.
Yeah.
Okay.
But you see, Glenn, this is why we did the blueprint. Excuse me. This is why, because this success story that James has here, not many people know about it.
Exactly.
We want people to know about that. There's a lot of small credit unions that, maybe their CEOs are retiring, or maybe they don't have a succession plan, or maybe they're just, financially struggling and don't believe that they can turn it around. So we really wanted to make something so people would know that, hey, regardless of where you are with your credit union, take a look at these other credit unions. You can do this. You can turn it around. People are out there. They're successful.
And again, like we always say, you're not going to find that from banks. You're
Absolutely.
not going to find them sharing these best practices.
And so James is a perfect story. And also, as you mentioned, his submission is in the resource guide. This is exactly why we created the blueprint.
Sounds like you could have done two. It sounds like the business piece in terms of the pivot too.
Absolutely.
And I challenge any small credit union that's out there, if they're afraid of regulation or they're afraid that things are getting to be, quote, too much, then I think that's really a sign on the leader. It's a time for the CEO or the senior manager, whoever it is, to really start looking for their replacement. If they feel like it's too much, it doesn't mean it's too much for everyone.
Good point.
And you need to hire someone with the capacity that can handle it. And that's not easy to find, but just giving into these mergers, I mean, I'm sorry to say it, but, in the state of Connecticut, since I've worked in credit unions since 2018, we've had over 20 mergers. Our credit unions have shrunk by 20. Yeah. And those are numbers that I'm not proud of, and have I been approached? Absolutely. I had lunch the other day when they asked me if I wanted to merge into them, and I said, thanks for lunch. Have a great day. It's not happening. Yeah. We didn't come this far to come this far.
Really interesting.
Absolutely. So.
So if I'll post a link to the blueprint, and if people want to find out more, Chicago Postal is
the website. Yeah, our website is it's a long one. We have a legacy name as well. Okay, 96 years.
I will also put it in the show notes.
Yes, please. So it is. We're at www.cpoecu.com.
That's not so bad. I was expecting something worse than that.
Yeah. But.
And what about Skyline?
Skyline's is a little bit easier. So it's just www.skylinefinancialfcu.com, or Google search Skyline Financial or credit union near me if you're in the state of Connecticut, and we're popping up first.
Absolutely.
Wonderful. James Higgins, Deborah Fierce, thanks so much for taking the time.
Thank you, Glenn.
Thanks, Glenn.
Right after that conversation, I headed back into the exhibit hall floor, which is where lunch was being served, and totally by coincidence, I happened to sit down at a table next to a gentleman named Eddie Todd. And it turned out he is a member of the board of directors of the Chicago Postal Workers Employees Federal Credit Union, whose CEO, Deborah Fierce, I had just spoken to. Eddie is a retired postal worker, worked on the night shift, and because of that, he says he was never able to attend the annual meetings and other meetings of the credit union. So he was very happy once he retired to actually have an opportunity to extend his service to the organization by serving on the board of directors. This is one of the things I love about GAC. These chance conversations you have with people that I would not have had a reason to meet otherwise. Fascinating conversation. He talked about some really kind of special stories, how he first became aware of the credit union while he was working at the Postal Service, how he had a challenge in terms of getting credit from banks, in part because of rules around wage garnishment around postal employees' paychecks that were in place at the time, and because wages could not be garnished from postal employees' paychecks, as he tells me, many banks were not willing to extend credit to postal employees because they would not have recourse if they needed to do something about a loan that went bad. Enter the credit union, understands the employee better, wound up getting his first loans through the credit union and has been a loyal member ever since then, and now a member of the board of directors. As I say, love those kind of stories. Always love also the annual economic update that the team does from the economics department at now America's Credit Unions. And we had this one this time at a weird juncture that economic statistics are actually doing well. Most people were predicting a recession in 2023 that did not occur. Inflation has come down, employment continues to be steady, and for some reason people are still just not really happy about the way things are going in general when you actually read the tea leaves of the consumer attitudes, although they have been improving lately. But right after they did their session on stage, on the main stage, and had a great audience for that one, caught up with the team and got a little bit more detail on that. So here's America's Credit Union's economics team. Here for our annual get-together with the economics team from America's Credit Unions, Mike Schenk, Ligi Votto, Dewi Kabede, and Kurt Long. And we you guys just finished your session on, how do we put it, economy on the brink? Question mark, I think was the way you laid this one out. So thanks, first off, just thanks for taking the time to talk. But, well, Mike, why don't we start with you? Is it on the brink? What's your take on where we stand for the coming year?
I was just trying to put butts in the seats.
It worked. It worked. It was a big room. You had the main stage, and it was pretty crowded.
No, I think I chose that title actually because we're forecasting slower growth.
Yeah.
We have the economy slowing, and the Fed has been pretty aggressive, and we know that monetary policy typically hits with a pretty significant lag.
Correct.
And so we're approaching what's sort of normal in terms of what the lag is, and I think that has a lot of people thinking that while things look great today, that might not last very long. And we're seeing a lot of other dislocations and concerns with just credit quality and that sort of thing. The regulators seem to be focused on it. So, as Luigi talked about, the Financial Health Network is measuring stress and seeing more stress.
I guess, one of the questions becomes who's on the brink, because, you still have consumers, at least right now, doing pretty well. I mean, right now wage growth is still looking good, but on the other hand, they don't seem to be terribly optimistic about things either. So it's an interesting twist, and at the same time, we are seeing some metrics, which Kurt will get to, around credit unions. That are, and the market, or the consumer behavior and everything for the GDP, whatnot, way outperformed expectations for 2023.
Right.
It's like you say, we're adjusting downward from there, but it's still short of a recession.
And I also think, price increases have come down significantly.
Mm-hmm.
We're getting pretty close to where the Fed likes to see that, but prices are still quite high.
Yeah, they never really come down.
Right.
They just stop going up. Yeah.
So I think households are struggling with that, making choices and engaging in behaviors that are more cautious. And it feels to me like the environment that would, in the face of a little blip here or there, Luigi mentioned
something that just
energy
pushes...
price spike or something like that, could be the thing to push us over the edge.
Yeah, Luigi, I thought that was a really good point when someone asked the question that one of the things that kind of set inflation kind of into the negative situation it was in for a while was an energy spike, and it could easily happen again. Yeah. More broadly, Dawit, you got into both the outlook for both inflation and both the way the Fed looks at it and the way typically we look at the cost consumer price index, as well as unemployment. Can you say a bit about where we see that coming out for the year?
Yeah. Unemployment, labor market has been very strong. We're seeing some moderation at the end of the year, but we think, as Mike mentioned, federal monetary policy works with a significant lag, and it does so especially on the labor market. So we think we will start seeing some of that effect, and as a result, that's why we increased our unemployment forecast to 4.3 from its current level now.
And again, for perspective, 4.3 is higher than it's been in the last year or so, but in the long term, it's still a pretty good number.
Yeah. So I think if you go back, 2019, 2018, unemployment rate for around 4% is not that bad. But again, we're coming from 3.7.
Yeah.
We're talking about if that the full unemployment rate comes from layoffs, that's significant. That's the number that Mike mentioned during the presentation, 700,000. We think some of that unemployment may be could be coming from the labor supply, but in general that this slight tick in unemployment is a case for concern, not just for credit unions but for all financial institutions, because we were talking about rising delinquencies, right?
Yeah.
When the labor market is very strong.
That's a good point. If it's doing it now,
if it's doing it now, and then what's going to happen? When we start to see these numbers go up.
And I mean,
so
it ties into the unemployment rate. But the other thing you pointed out is job openings and the number of openings per person looking for a job, and those have been very high lately.
Yeah.
And those are coming down too.
They came down significantly. The Federal Reserve at some point actually used that metric, the unemployment, the vacancy to unemployment ratio, as an indicator for how tight the labor market was.
Mm-hmm.
So it was very important, and it was one of the indicators of underlying impact of the labor market on inflation, because that drives wages. When people are, when that number is high, people can easily switch jobs, and that has a significant correlation with inflation.
And I think it was
that coming down significantly.
And it was still, is it currently still at 2 open jobs for every person?
No, it's
come down.
1.4.
It's 1.4 now. It was 2.0.
It was 2.0. I did speak. Okay. So it's good. It's still slightly higher than pre-pandemic, but it's going closer to that. And a lot of people are also saying that maybe that unemployment, the vacancy numbers that you see, it may not be 100% because employers want to retain talent because they have faced a lot of problems in attracting and retaining and hiring talent. So they may have these vacancies out there.
I've heard that argument. They're not
that may not
recruiting.
necessarily actively recruiting those people. But either way, like using that statistic and also the hiring rate, we're seeing that motivation.
And the other one, it's obviously it's a high level number, and the openings may not be for the skills of the people who are out looking for work.
Exactly, there's a matching problem, but a very good report from the Beige Book, which is a survey of businesses from the 12 districts. A lot of businesses are reporting they are able to find the talent that they want,
which is
relative to a year
which
ago.
was not the case.
So there is a better matching now than it was a year ago. So all these indicate what the Fed says is we are looking at better balance in demand and supply in the labor market, also in the product market when it comes to inflation.
Just don't declare success too soon. It's kind of their attitude. Yeah. Lisa, you came up with a point that was my favorite takeaway line of the entire thing, the Vibe-cession, which I'd never heard before. Can you kind of talk about consumers' attitudes kind of being out of sync with the numbers?
Yes. I love it because I believe in vibes a lot. I believe in energy. And so even though the economy is strong and consumers are spending a lot, even more than before the pandemic, right? They just have the sense that things might change very quickly at any minute, any
So kind
time.
of like we were just talking about, that one push that might change the story.
Yes, and so consumer sentiment has been below average, and it has been more around the lines of recessions. So people are feeling right now the way they feel when there is an actual recession.
Which really makes you wonder, if we actually do start getting into one, what's consumer sentiment? Are they just ahead of the curve, or what? It's an unknowable.
So you talk about self-fulfilling prophecies, but I do think that the market indicates that there's still room for more spending, which might positively impact growth too. That's
a good point, and that's you also brought up the piece about, I never heard the trickle-up effect before. Which I thought was fascinating.
So what sector of the economy have that capacity to keep spending, right? And according to that theory, the bottom 80% of the income distribution, that is low income and middle income, where credit union members lie within the middle income spectrum, right? So according to that theory, they have exhausted, they have used up,
so they had that excess stimulus, and because they actually had need for it right away, they've already spent it. So the excess savings is still sitting with the higher income where they don't need to spend more.
Well, so there is an in-between, like in the 20th percentile of the income
mass
distribution,
affluence,
they still spend. So that's where we still can see some more spending, and that actually you correlated with the high checking balances, checking account balances above trend. So those balances are in some consumers' checking accounts.
Yeah, that makes it's such an interesting one, because I think we are getting certainly to the end of that trail, but maybe we're just not quite there yet.
Right.
So,
Yes.
Interesting. And Kurt, you had a couple of metrics. I mean, again, the interesting part is we're talking about the consumer, but we're also talking about the health of credit unions. Return on assets has kind of trended downwards. Loan delinquencies seem to be kind of on the uptrend. Can you say a bit about what you saw there?
Yeah, I think in general, forecasting the credit union industry is frankly not that interesting because these ratios tend to be very stable over time, but there are exceptions. And so, of course, around the pandemic, we just saw a ton of volatility in those credit union metrics, and I think we're still seeing a little bit of the after effects, sort of the whiplash of that, of things, settling back into a more normal position. That notwithstanding, I mean, there are some real challenges that credit unions have been facing for a couple of years around liquidity, around higher interest rates. And so even though I think the group has some optimism that there may be some improvements in one respect or another, it's just going to take some time, for these things to work their way into the credit union industry. industry.
Well, and you mentioned that it looks like the trend on return on assets is kind of looking like it's going to be the lowest since, I think you said, 2010?
That's our outlook.
Yeah,
that's
so
right.
Which, again, it's not bad. 50 basis points, it's profitable, but it's not, it's not the fat, dumb, and happy times. Let's maybe put it that way.
Yeah, that's right.
And then the other one, I thought, that loss provision has kind of gotten back to, a couple of years it was almost like zero, and now it's kind of back to where it was. But again, that takes away from, the bottom line.
Yeah, and I think it's that piece in particular where most of the risk lies, because, we talked about our outlook for the unemployment rate. If the reality is worse than our outlook, then you can easily see that number going up from where it currently
I'm
is.
getting my little on the brink kind of
Yeah, that's right.
vibes coming back again now. The other point you made that I thought was really interesting was fee income as a percentage of overall, was it a percentage of assets?
Percentage of assets. That's
Which has been trending down, as you said, pretty much consistently since at least a decade, right?
Mm-hmm.
And yet, even though, again, that's taking away from income, and yet we're seeing pressure on, quote unquote, junk fees.
If all you did was listen to the regulators, you would have no idea that that's the trend, and yet it is.
You look at the chart, it's a consistent downward trend. There was that one tick, I think was that maybe, I forget what the event that took place, right? There's a kink in the curve where it came down.
Well, there was
more
a
dramatically.
big drop, and that was
Was that Durbin, or is it since then?
that was the pandemic, because assets grew
Oh, right.
overnight.
So the denominator
so much. That's
changed.
right. the
That's why.
denominator.
That's right, because Durbin would have been even before that slide. I don't think he went back
Yeah,
to
that's right.
2011. Okay. It's interesting. It's just an interesting and another thing to be watching. Something else that came up, and you and I were both, actually, Mike, you were there too, on a workshop for academic papers recently.
Yeah.
And there was a paper that this was fascinating to me. You mentioned that there's analysis that was done on student loan forbearance and the way that excess money was dealt with by credit union members as opposed to customers of other banking institutions. Can you say a bit about that?
Yeah, so this is a research conducted by 4 professors, 2 of them from the University of Arizona, 2 of them from the University of Connecticut. So they want to see, consumer behavior and financial decision making in the face of for the COVID-19 forbearance on student loans. So they just wanted to test.
So suddenly people have more disposable income because they don't have to make their student loan payments. Right?
Exactly. So the question is, do they think this is a windfall, or do they just use this for the intended purposes where, forbearance is just for caution, bad times are coming. So this is just, one way the government helps consumers, to cope with this shock. And the answer is, yeah, indeed, actually consumers use this, saw this as a financial windfall, and they went out and increased their spending. So they looked at their balances, borrowing balances, and then it has increased significantly. But when they look at it by financial institutions, they found out that most of this increase comes from national credit card companies, about 30%, and banks, 25%. Whereas credit union members increased it only by 8.5%. So that's lower.
That, and clearly beyond the level of statistical significance.
Exactly, yeah. And then, when you think about it from, of course, yes, we are seeing, rising delinquencies. And then most of these delinquencies being seen in subprime area. But if you see the exposure because of this behavior, like if this turns out to be really bad, you can see that credit union exposure is very small.
Yeah, that's a good point.
Yeah.
So yeah, good news on all sides, I guess, on that one.
Yeah.
Well, you do regular, are they quarterly or monthly economic updates that you post, and are those available at the America's Credit Union website, on YouTube? I forget where they are exactly.
We do these quarterly.
Quarterly, okay.
Not necessarily
To this level of detail.
Yes. So roughly speaking, quarterly, and we summarize the results of our gathering and typically post them on our website.
Good.
Yes.
Okay, well, I'll post a link to that. Most recent one, I think, did you do at year end, maybe in January? So this is
Did it in
obviously
January.
more recent.
Yes.
Okay. But yeah, this was great stuff. Really appreciate you always taking the time, and obviously we'll be following along to see just how on the brink we turned out to be. Kurt Long,
Great.
Deweet Kibete, Mike Schenk, Lee Givato. Thanks as always. I always enjoy taking the time to talk to you guys here.
Thank you.
One of the things we discussed as well is the fact, and this comes back to the whole notion of advocacy being job one for America's credit unions. Jim Nussle had made this point that junk fees, that phrase has really been co-opted and politicized to this point, and basically any kind of a fee that people don't like is kind of getting kind of swept into that overall category and winding up using that as a rallying cry. And we saw that a bit with the junk fees that got announced in terms of the credit card late fees. It's being positioned for the most part as a cap, quote unquote, of 8%. Technically, that's not true. It's more of a threshold, I would say, and it only applies to credit unions or financial institutions, I should say. Very few credit unions are directly impacted from the letter of the law. Anybody with under 1 million accounts is not subject to this. That kind of defies the general principles of economics, however. If we know the big players are only charging a certain price, you're not going to find another category competing in the same marketplace that can suddenly charge a different price. So it's a little bit of smoke and mirrors on that one. And again, the types of things that we're looking at and fighting for the interests of, and that's one of the things that America's credit unions continues to look at. So always appreciate these conversations. With that, I think we've covered enough ground for 1 week of content. Had some other conversations we want to share with you in the future, and we'll have some more content from the Government Affairs Conference over the next week or two. Until then, you can always track down more about the Best Innovation Group, big-fintech.com. If you go to the Media tab, you'll find this and other past episodes. I'll point you in particular to a great conversation we did with Caroline Willard, the CEO of the Cornerstone League, representing Texas and some of the other southwestern states in the credit union space, and a board member of CUNA, talking right after the announced acquisition between CUNA and NAFCU about a little bit of the inner workings of what was going on around that combination. I thought that was a great conversation at the time and is still quite relevant. Also, our interview with Zach Cass on generative AI last week, which I've got some great feedback on. Really interesting conversation that I think obviously has great implications for the financial services space, but really goes beyond that. I think you'd enjoy that one. If you haven't heard it yet, definitely do go back and take a listen. You can always find more, as I said, at the website, big-fintech.com. You can find John Best or myself or the Best Innovation Group all on LinkedIn. We have also joined Blue Sky, the Jack Dorsey social network that he started up after leaving Twitter. And now you can find us at JB FinTech for our Grand Poobah John Best, at Big FinTech for the organization, and myself, Glenn Sarvati, through my organization there at 154 Advisors. We'll be back with more content next week. As always, thanks for listening.
Check back each week for the latest from the Big Cast. Or better yet, we hope you'll consider subscribing for free via Spotify, Stitcher, Apple, or wherever you get your podcasts. If you have questions or comments, we'd love to hear from you. Tweet us at Big FinTech, email info@big-fintech.com, or visit us at big-fintech.com and click on the Media tab, where you can post a comment or check out our archive of hundreds of past episodes. See you next week.